Why do you always offer IO and seller financing? So interest only, IO, interest only. The reason why I always do that is because it decreases my debt cost drastically. And if I can have very low debt cost, the odds of me being profitable are much higher. Keep in mind that the rate of return, your internal rate of return, your IRR, doesn't drastically change actually, whether it's amateurized or it's IO, because you're going towards principal, right? Like, so it's interest plus principal. So it doesn't really change a lot, but I like the cash flow in the meantime. Obviously, more seasoned investors are like, just do amortization because they like it. They like paying down the debt because they don't. A lot of seasoned guys who make a ton of money already have unbelievable amounts of money, right? They're like, I'll just amortize the loan and I'll pay it down faster. For me, I want the cash flow now. And it says, didn't he say he wanted $2 million? Yes, he wanted $2 million. Way too much money. All right, Alex says, would value add? Because I only think it's worth $1 million, maybe $1 million too. Alex says, would a value add deal like this trade at a lower cap rate because it has upside potential? For sure, 100%. I agree it will, but it's not going to make it worth $2 million. It rarely isn't. And to be honest, like I said, I don't mind putting this in front of a few buyers as long as you have a correct expectation and you set up an expectation, like a correct expectation for yourself and set up a correct expectation for your buyer to say, this is all the information we have right now and we're not getting anything more unless we're willing to pay this price. So this would be good for somebody who's like a local Linden investor and doesn't mind buying a super low cap rate because maybe they'll pay in cash. But that's going to be really it for now, for the type of buyer. And it's going to be rare, especially guys like, look, when interest rates are this freaking high, you need to keep in mind, like, it's going to be, you need to have infinitely better deals. We had a guy even talk to us today, like he was struggling to get debt on a 7.5 cap deal because rates are at 7.5%. Right? Like, so it's like if hypothetically rates were 4%, but you're buying a 4 cap deal, it doesn't make it a good deal. You want a 2% minimum spread between interest rates and cap rates. At minimum, obviously as you get more seasoned, you might be able to get away with at least 1% spread, but 2, like again, you and I are, if you and I are looking to invest in a deal together, I'd say I want at least 2% to have enough cash flow. Let's go to the next question. Great question, Al. Okay, Alec, you said, do you have an underwriting spreadsheet exclusively for multifamily? So we do have one, so let me bring this up for you. So the math for cap rate offer is typically 7 cap if you offer 5%. No. I want to be offering, in this situation, I'm offering 7 cap because I know this market and the price per square foot is unfreaking believable and there's a lot of upside. So typically when I'm making an offer, I like to doing if rates are at 7%, we're trying to hunt for 9 caps. Correct. Now, obviously I want to give you an understanding, Dan, obviously you're in New Jersey. In New Jersey, this works. Most of the time, at least say for central New Jersey and northern New Jersey, 7 offering a 9 cap all day long makes sense. Just keep in mind that some areas of South New Jersey are very northwest. Even if you have a 9 cap, it doesn't make it an unbelievable deal, right? It doesn't make it a great deal in that instance. So just keep that in mind that it's not just a blanket statement. I look at it as sort of like a minimum metric kind of thing to look off of. Your local market is more important to understand. If your local market, I'll give you an example, the very similar example. I've talked about this a few times. I had a mobile home park in the upstate New York. Upstate New York is very rural, very, very rural. I had it at a 14.5 cap. Okay, I had it locked at a 14.5 cap, and I was trying to sell it at a 12. I mean, I wasn't trying to sell it at, still a great deal in my mind. However, in this local market, guys, this market, by the way, it has less than 1,500 people living in it. It is so rural. If you had a vacancy, who the hell's moving in? So there's nobody there. Now, obviously, if you found a 14.5 cap in one of the main markets, if you found that in Buffalo, New York, right, where you have 100,000 people living, you're probably going to be okay. But in the middle of absolutely nowhere in New York, where the closest town was literally 50 miles away, right, it doesn't matter that it's a 14.5 cap. It just doesn't matter, right? What are you going to send some random person? Who are you getting as a handyman to drive 50 miles? So you just got to be careful of what you're looking at, right? Because every market is different. Garth, you said, I have a couple deals with full information, but I am not able to find people who want to buy things that are smaller. Fastest way to find a buyer quickly for it. Okay. A lot of us are in this type of situation. Keep in mind that I think that one of the biggest things to think about when you have a new deal and it's a smaller deal than people typically have bought in the past is that you need to be thinking about it from the lens of, if hypothetically I needed to find somebody in the next 30, let's say if you and I are just sitting at a table, who would buy this deal, right? If we just think really simplistic for a moment, we're sitting at a table together and we go, hey, this property, 5,000 square foot industrial or 10 unit multifamily property, a little bit on the smaller side, who would buy this? Well, if we just think simplistically, somebody in the local market who has bought properties before. So it's like, if you have any type of asset, this is the first thing I think about. It's like, who would buy this property? Again, a local investor who has bought stuff in that area before clearly would probably want to be the most likely to buy another property, right? So if you hypothetically have, right now I have a guy who's looking for office buildings in Jackson, New Jersey. And I go, okay, so if I come across a property in Jackson, New Jersey, that's an office building, who would be the most likely person to buy this asset? Well, someone who probably owns 5 other office buildings in Jackson, New Jersey, right? Like, this would be this pretty, again, we're just talking simplistically. This doesn't have to be rocket science, guys. Like, again, I didn't graduate college, right? Like, this is not freaking rocket science stuff, okay? So it's like, okay, if that is the case, where do we find that data? Well, you can go to CoStar. You can go to CREsync, you can go to Reonomy, you can go to any one of these platforms and just say, hey, what has sold in this town, right? This city within a 5 mile radius, 1 mile radius, quarter mile radius, depending on the area, that is as similar as possible to the asset that you have. So if it's a 5-unit multifamily, smallest commercial multifamily property you could have, you would look up mile radius around your subject property, what has sold last 12 months, 5 units to 10 units. And you just look up every single person who's bought a property in the last 12 months and try to find people who maybe own 2 or more properties in that area, whatever little market you have, right? And you're going to come down to maybe 3 people, a dozen people, whatever it is, right? Depending on the size of the scope that you look out. And plus, again, look, I would probably call the people who own 2 or more properties first. Then you call everybody else, anybody who's bought a property in the last 12 months. And then you can go back 3 years and you can be like, oh, I see people who own 15 properties that they've bought in the last 3 years. Okay, awesome. I would call that person. And that's the simplicity of it. Reonomy does a pretty good job of that.
Yeah, so just so when I'm pulling it, like I don't know how to see who purchased it through CREsync, and so like I'm just trying to find an efficient way to find who these buyers are, because obviously I could pull up individual properties, but how do I get like here's a list of the people that match that? I guess I could pull it through Reonomy and say, hey, I want properties that have sold. And then try to find...
Reonomy can do it. I'll pull it for you right now. Sorry, I'm just trying to confirm that this spreadsheet has everything you need for multifamily.
And this one is it's the 12-unit deal we were talking about last week. I got them down to I gave them the LOI. I got them down from 1.2 to 1.1.
Yeah, so okay, so like a reasonable... let's jump into that. So hold on, I'm just going to do this one here. So we're going to do underwriting spreadsheet multifamily. This is for all of you guys. Actually, let me make a copy of it. That'll be the best way to do it. Hold on 1 second. File, make a copy. Howie also says PropWire is free. Deal Machine works great to skip trace. Deal Machine will also show you all the properties that they own. Love it. Yeah. Deal Machine is also decent. I don't know if Deal Machine does a great job specifically for commercial, but I know that it does a fantastic job for residential. We'll go through here. Okay, Alec, can you go over how to do retail lease comps for someone who is not too familiar with the market? I'm having trouble figuring out what the price per square foot would be and how accurate the estimates are on CoStar. 2 things. 1, keep in mind that CoStar is always going to give you the best data. Always going to give you the best data. And then the second best place you could look at is LoopNet. So if you have access to CoStar, which Alec, I think you do. So if you're on CoStar, I would just look up lease comps, do a radius search, retail, and look for the most common stuff and look at 10 of them. And just take 10 of them, write them all down, and just say like, okay, it's 15, it's 16, it's 17, it's 14, it's 12, it's 17, it's 16. Write them all out, run an average, and there's your square foot. Now, and obviously I would also do it because it also depends on square footage of the property. Because if you have hypothetically a retail shopping center, each space might be 1,000 to 2,000 feet, and you might look at a comp that has 10,000 square feet rented at $12 a foot, even though your 2,000 square foot or 1,000 square foot space might rent at $18 a foot. So you just have to be careful. Like, okay, you want to do comp, apples to apples, right? So like similar square footage to similar square footage in a similar area. Take 3, 4, 5, 8, 10 properties in those similar areas, and you're going to have the best idea, right?
I think that's where I was getting tripped up, because like in residential, you can't compare a ranch to a 3-story, but I'm kind of figuring out like what can't I compare to on the retail side.
Sometimes you're going to have to take a 3,000 square foot standalone building and compare it to a 3,000 square feet inside of a shopping center. You're like, if there's not a lot of comps, right? But you're also going to have to realize like, okay, well, someone might pay more to be in a nice shopping center versus a shithole shopping center across town, right? So it's just like paying attention to like little small things. So I'll look at like, okay, look at the pictures. Like, how nice is this shopping center versus the one down the street? How is this, because like, look, if you have a corner spot, right? Like if a shopping center makes an L, right in the little pocket of it, of the L, is like the worst location because you have the least amount of visibility. So like that space might rent for less. And like, it's just like a lot of these little nuances that you kind of pick up from looking at all these other properties over time. So, and if, by the way, if you have a property specifically you want to look at and you want to send me comps, I can be like, hey, this one doesn't make sense. This one does, this one doesn't, you know? So no matter what you need, you got it. Alani, if you want to come off mute, we can talk about this deal real quick. You said you have an LOI on a deal listed for $2.2 million. Your buyer won't go above $1.7 million cash. Wanted to find an explanation to the seller as to why our offer is good and and want to take a look at it. Yeah, yes, I definitely do.
Let me forward you the financials maybe later, then you can look at it. Because you're going to ask me for a lot of questions that I need to look it up.
Well, yeah, I mean, look, yeah, if you want to just send me everything via an email and I can respond to you that way, if that's what you want, we can do that too. Awesome.
Real quick one, kind of alluding to the question I had before. So I come across a lot of multifamily, especially people who they're sick of dealing with it. They want the cash flow still, but they don't want to deal with it. So I'm like, okay, a seller financing deal will probably be the easiest. But then they're like, okay, what about, the capital gains tax? It's crazy too how many people who own commercial real estate don't know what a 1031 exchange is, which blows my mind. So is it a good idea to...
There's real estate agents who don't know what 1031 exchanges are.
Right. Is it a good idea for those sort of people, if the price, if we're close on price, to find them, like a single tenant retail building, triple net, no landlord responsibilities prior to doing anything? Or would it be kind of like do it as we're negotiating the purchase agreement type of thing?
Okay, so a couple things. So if you're ever dealing with somebody who goes like, hey, I don't know what to do with my money, or I have to do a 1031 exchange, I need to mitigate my taxes, okay? A 1031 exchange is obviously a reasonable option for them. Now, it's not the only option. I mean, like, look, if you don't want to pay taxes, which everyone in the world is like, why on planet Earth do I want to pay taxes, right? Like, everyone wants to mitigate their tax basis. There's only so many things you can do. You can either do a 1031 exchange, or you can do seller financing. That's it, right? You don't have 1,700 options here. In the 1031 exchange, you have options underneath that umbrella, but you need to then reinvest the asset, right, or the cash from the asset that you sold, right? So you can invest it into another similar asset, triple net property, like any commercial property, a rental property to rental property. So you can go multifamily to a triple net lease if they want. They can go into a DST, right? They can go into which is like basically a government backed bond, essentially, that's guaranteed a certain rate of return. Or you can go into some funds. Some funds are also 1031 compliant. By the way, you got to talk to your accountant about this, but you also hypothetically could tell them, you also technically, if they have no debt on it, which is typically best, you could tell them that they could buy a second house. Now tell them to talk to their accountant about it. But legally, what you can do is it can't be a primary residence. It has to be another rental property. But technically, if you bought a second house, let's say you have somebody you're in like Detroit, right? The larger, okay, cool. Someone could buy a house. Let's say it's a $1 million house. I mean, a $1 million multifamily. They could sell that $1 million multifamily. They could then buy a $1 million waterfront condo, okay, in Florida. You can be my neighbor. You can be my neighbor here in Florida. You can get a condo here or a house or whatever you want, okay? Come say hi, you're now my neighbor. And you can rent that property out for a short period of time. You could then hypothetically, and I've seen many investors of mine do this, you could buy that property in an LLC, 123 Main Street LLC, and then lease it back to your investment company LLC. So you could basically rent it back to yourself. There are ways to do that. Now, again, I'm not telling you I'm your accountant, but I'm telling you I've seen, and I have friends who have done that several times, where like legally it's owned by an LLC that isn't him. You could do that. Now it mitigates, as long as the money is reinvested in an asset that isn't a primary residence and it's a rental property, right? Like he will then pay himself. You have to pay yourself through LLCs, right? And like say like this LLC is going to pay rent to this LLC for $5,000 a month or $4,000, whatever it is. You can do that. That is kosher, right? Like that is totally okay. So like you could technically try to say to them like, hey, like, instead of having this property that quote earns you money, if you're not living off the money, you don't need it and you're open to selling it, you could just have a second home and you can actually go enjoy it.